Welcome to the Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is November 19th, 2020. The S&P 500 is currently hovering around 3560. We're recording this a little bit early this week, so we don't have Friday's close with us. And as we always know, the close knows. And I'm David Zarling. I'm here with Ian, Let the Alpha Dogs Out, McMillan. We had another gap up on Monday, Ian. Let's start there.
Yeah, another gap up, just like we saw last Monday on the 9th. This time also, again, like last Monday, led by small caps. And we still have actually not seen, interesting fact, we have not seen a move of less than 1% on a Monday session since August.
So plenty of movement on a Monday.
Yeah.
Movement Mondays since August.
Big moves.
Yeah, for sure. And that,
Now we didn't get a circuit breaker this week like we did last Monday.
With small caps, right?
Mm-hmm.
Yep, the circuit breaker. But we continue to see these, moves and gaps happening. And I know we've talked about that characteristic in the past. In fact, since the bottom, since March 23rd, 50% of the S&P 500 return is coming in the after-hours session. And I don't mean 50% of the return. I mean 50% return is in the after-hours session, just 6% during the day session. And this is all happening.
Wow.
The recent price movement is happening despite another thing we've talked about in the past, a wall of worry. Do we have any things or anything that we could list that would be labeled a brick in the wall of worry, right? Because we talked about that back in March when the market was rising, and it didn't necessarily make sense that the market could be rising with, one of the largest job loss prints on record. Or do we have a situation like that, or are we at a moment of peace and everything is hunky dory, and that's why the markets has moved a little bit higher or made a new high, or do we have other things that could be considered?
Well, I don't know if the market's ever in a hunky-dory situation.
I don't even know the definition of hunky-dory, but I've just heard it said, and it kind of sounds nice.
It does sound nice.
Yeah, so you're right. I don't know if the market's ever in that situation of hunky-dory, but
I guess if you're someone who's really big into waiting to see who wins the election so that you know what sectors and industries to buy, I guess that's been probably frustrating. There's an unknown there. I know a lot of people said that the market can't go higher without stimulus. We still don't have this. I don't know if it's the second or third round of I guess it'd be the second round. States going back into lockdowns, mask mandate extensions, schools are starting to close. So I would say there's definitely some bricks there. I guess you can take the vaccine brick out. Again, I know I said this last week that I could argue we've been pricing in a vaccine since late March. So,
well, and I think that's supported by the price action of one of the vaccine deliverers, Pfizer, that we talked about in the past, that if you had bought Pfizer on the morning of the 9th when that was announced, you'd be negative. So, like you said, price moves first, news is second. So the quote unquote pricing in of things is more grand than people may like to realize.
So Pfizer still is down from last week's open. We mentioned last week that on the first day it was down 6 or 7%, and it's fallen another 3% since then. So again, if news is your thing,
And Moderna, the same thing. Moderna's, if you had bought the morning of the 16th based on Moderna news, you're still in a negative position based on buying the vaccine news in those individual stocks. So to think that listening to the news or watching certain financial news networks is going to give you an edge, you're going to be completely misled. By the time it's reaching you via TV or internet, that's already something that's grossly known. And so we continue to see, because we've talked about in the past that we could see stocks overall sell off once a vaccine has been announced. Now, we haven't seen that. We've seen the individual stocks for those vaccines not regain the price that they were.
Stocks for them. I mean, obviously with small caps outperforming, we can definitely get this. I think this is a good topic for the extended version, but from a numerical standpoint, lots and lots of more stocks showing up, especially in the relative scan. So lots of new stocks outperforming,
which fits the small cap theme. And on Monday, a thing like the S&P 500 recorded a new all-time daily high, and that's about as bullish a thing a market can do is record new highs, right? When we look at
why do you think that there's so much anxiety around that?
I think, the anxiety of I can't believe the market's at all-time highs. Some people, that phrase actually gets them scared or afraid. Oh, the market's at all-time highs. That can't be good. I think that has to go back to an old market mantra, which isn't a bad mantra, but it's a little bit of a misnomer. And that is buy low, sell high.
Oh, yeah.
Right. So
now that they're being told that it's high,
that's when we should sell. Right. But if you had done that in 2017, in 2017, we had 62 new all-time highs.
Wow.
So if you had sold any of those, you'd have been out of a great market. And so really a mantra I'd like to pass along that I know many in the industry know is you can buy high and sell higher. It doesn't have to be buy low, because sometimes you can buy low.
I mean, how is the Dow, going back to the 1890s? It started, I think the first day it traded at a value of 40, and we're at 28,000.
Right.
So, I mean, that's a series of higher highs and higher lows to me.
Well, and it goes back to new highs are a hallmark of a bull market. For example, some years that didn't record new highs are like 2012, 2011. Market was rising, but basically from the year 2000 on towards 2013, we weren't recording new highs. So that, not recording new highs is actually a bearish characteristic.
And that's why I think so many technicians argue that, the current bull market that we're in really didn't start till 2013.
Right.
Because that's when because other than that, you were just in a consolidation pattern. You didn't know that it was going to
consolidation. Yeah.
Right. No one that bought stocks in March 2009 was saying, I think this is the beginning of a new bull market. No, you weren't.
Right.
And I mean, because going back to the 2000 highs, you had essentially just consolidated for 13 years. And look at the move we've seen. I mean, when we broke out of those highs, April, spring, I think it was April, May 2013, somewhere in there. I mean, it was a pretty strong trajectory until really 2015. So you had 2 years of just really strong price movement, and really the last, the last 7 years have been a pretty strong uptrend when you zoom out and look in the grand context of, the market data that's available.
Well, and at the same time, we don't get to sit here and say, oh, 2013 is the breakout, which it is, but then say, oh, we're, 7 years into a new bull market. I would disagree with that too, because of the bear markets that took place in 15, 16
Mm-hmm.
and the bear markets that took place in 2018 and this panic crash in 2020. So not only did you have these breakouts, so it's not, we don't get to sit here and say, oh, a bull market is long in the tooth. It's not. And we recorded new highs, and that's one of the most bullish things that can happen. There's been 24 new all-time highs in 2019. That's not, or I'm sorry, in 2020. That's not a bad thing.
And a lot of people will say, a lot of people will argue, oh, well, 2015, 2016 wasn't a bear market because we didn't have some big dramatic drawdown of
it was a couple. Yeah, I was going to say the 2015, 2016 was a percent or less than the 20% definition. But
you also had many, I don't think you want to tell energy investors that there wasn't a bear market in 2015 when their max drawdown was close to, I think, 40% that year.
A lot of sectors were down 20+% in 2015, the end of 2015, beginning of 2016. So there was a stealth bear market that took place.
And that's kind of when we saw this shift to tech, because coming into 2017, after the election, right? So we had the two drops going into November 2016, and tech had pretty much been flat against the S&P since the 03 bottom. But coming out of the 2016-20 election and into 2017 is when you really start to see tech and growth take off.
Right. Exactly. And that's been a theme we've been seeing. Now we've seen that opportunity cost for those areas show up when we compare tech and growth versus something like small caps. That doesn't mean the larger picture trend that Ian is talking about, that's over. It's just something that, whether it's how we construct portfolios or just noticing the different characteristics that are in place right now, there's not a definitive track of trend on a relative basis of tech. And that could return. Okay. Some of the big names right now have been consolidating for a while, whether you're talking about Microsoft, whether you're talking about Amazon or Apple. Microsoft hasn't gone anywhere since July.
Whew.
Amazon, basically the same. It's actually less than it was back in July. Apple's another big one. Same thing since August for Apple. But those are some big names, some big tech names that have cooled off. That doesn't mean there have been other areas in the market that have done well. I know.
Markets.
Yeah, you've used
it's almost
the term,
a little overwhelming.
Yeah, you've used the term barbell.
When small caps outperform, it causes a lot more work for
the
people like
team.
Me.
Yeah, the adaptive team.
It does,
because there's more. It makes a lot of sense. So we're going to kind of talk a little bit about that in the extended version as a teaser. That when you have an environment where small caps start to outperform large caps, there's an expansion of stocks with setups, and we'll get into that. I think you guys are going to find that pretty insightful. Now, one thing I kind of want to touch base on is a lot of nerves, right? A lot of anxiety over new all-time highs, anxiety about the election and undecided presidency. Would your bet have been that after the election that VIX volatility would have been crushed? And when I say crushed, I know that's a little bit of a, using hyperbolic language, but it definitely moved down. Volatility moved down rather than higher.
Yeah, we've gone from 36 to 23. I guess it's been 16 days since the election now.
And Ian's referencing the VIX, which is a volatility index.
And we're back to this 22, 23 area, which is where we have support from August. And, then we saw it start to pick up and into the September sell-off. So we're back down. They really need to see it. That was also the gap up on VIX. We have a gap that hasn't been filled going back to the February 24th, that Monday. Speaking of Mondays.
That basically back when the panic crash happened, the VIX has not, implied volatility has not dropped below that level since then. And that characteristic can continue, right? We talked about in the past that volatility could be here to stay for a while.
It
It
can.
doesn't have to. A clue that it doesn't have to is closing below that gap, being below 21 on something like that would be information. So volatility continues to be in play, not to the level it was during the election. So we continue to climb this wall of worry, and we've got some interesting areas of development. Besides just the small cap, large cap story, are there some interesting areas that we should be highlighting that are starting to show some relative strength?
I think there's a lot of areas, especially in the small cap arena. Industrial still strong. Cannabis, I know we've talked about that for a couple of weeks, still strong. Bitcoin still strong. Gaming, so casinos and things like that, looking very well. Rare earth metals and miners.
Yeah.
How about timber and forestry names? Automakers. Kind of going back to industrials, especially those industrials that are tied to like the agribusiness space. And then, of course, right, we're seeing all these kind of new areas that we haven't talked about in months because of, and if you want to call this a bottom up approach, but we're seeing it because we have these other, micro caps and small caps as a whole breaking out on a relative basis.
Right. And when we think about risk on versus risk off characteristics, you don't go typically hide in micro cap names, the riskiest of the stocks out there when there's pain coming.
No.
And so, it's information that we're seeing something like IWC or micro caps outperform the S&P 500. That's important information. Like you've talked about several times, we're seeing small caps break out on a relative basis versus large caps. And then we've got these unique areas. I mean, when we're talking rare earth metals and timber and forestry, those are some pretty unique areas.
They are very unique. I think that goes back to the strength we've seen in materials, along with base metals. Gold miners and silver miners continue to get hit hard, of course. They've really only been able to put together one, I would say, solid run. They're a finicky group. They remain a finicky group. Financials, banks still look great. So just lots of areas. And these are areas that are, as we said, if tech is going to take a breather, especially from a relative standpoint,
got to have that rotation.
You've got to have these other areas move higher, especially retail. And that kind of fits with the small cap discretionary, but good things. I mean, lots and lots of stuff to choose from. And again, maybe this is a better for the extended period, but you see it daily on breadth measures. I mean, if you're running, and you can use simple scans as breadth measures. If you run them enough and you get used to them. But the price action that we're seeing now with new relative highs, even in kind of this sideways market, we've essentially been sideways since September 2nd.
Yeah, if people can picture it out there, this S&P 500 since September has moved sideways.
Hasn't gone anywhere, but you're and so you would see, maybe for me personally, and what I like to look at, 100 to 200 stocks a day making new relative highs, and those can change, in and out. But for the most part, a few hundred.
Right.
Now you're seeing.
I'm gonna have you save that. That's gonna be our first thing for the extended portion. Is I want to talk about this, what you're talking about with the scans and seeing a market that's moving sideways, what characteristics are showing up there when you do your scans. I want to touch base on that. So we'll save that for the extended. I want to touch base quickly before we wrap up the client segment on treasuries and rates. Because you mentioned, banks holding up very well, doing well. And we've talked about in the past how rates have an effect on that. And we have seen rates rise, but we haven't necessarily seen them hold, whether we're looking at something like a 30-year rate. We talked about the importance of the 1.6 level. We're back below that now. That doesn't mean it's heading lower. It just means that we haven't eclipsed the high in 30-year rates, which was June 4th, in a shorter time frame than, let's just say, this year. So we haven't eclipsed that high, but we are seeing rates hold up well, which makes sense that banks would be holding up well. Anything else in the bond complex that we're seeing that would be notable to pay attention to? Like, for example, I think of like corporate bonds seem to be holding up well. That's not a risk off
Corporate
characteristic.
bonds. I know we talked about high yield spreads last week. I would say, the most sensitive when you get into discussions about rates. So we know that longer term dated fixed income is going to be more sensitive to interest rates. And when you look at something like TLT, which is 20, 30-year treasury bonds, I mean, you've still got a series of lower highs and lower lows. So
Exactly. The very
somewhat
definition of a downtrend.
maybe kind of a divergence there. Now, I think it'll be telling what happens if we fight through this divergence and make a new low. That will be a clue that they're pretty serious about selling bonds.
Yep.
Anytime you get a divergence and it fails, you fail to see a follow through in price.
And you're talking about an RSI divergence on something
Yeah.
like TLT, like between the October 23rd
Mhm.
and November 10th. You
Mhm.
created a lower low in price, but a higher low in RSI. But we're still in a downtrend, like you mentioned, on a daily time frame, lower lows, lower highs. And I think it's fair to say a level like 155, 156 on TLT, if we're below that, they're pretty serious about selling bonds. Is that a fair summary?
I would agree with that.
Okay. Anything else you want to highlight before we jump to the extended portion of the podcast?
No, the same mantra that we preach to clients every week and the listeners of the podcast, urge you to please avoid making investment decisions based on anything you hear in the news or because they are here to scare you. And
The fear factories.
I feel like we've just had plenty of examples over the last we've had them throughout history, but particularly in 2020 about just how bad things are. And we are sitting, 1.5% from all-time highs in stocks. So
Right. Exactly.
you tell me.
Right. We can turn off the fear factories and focus on price, which we do on a daily basis for our clients. And you're a big part of that, Ian, and I appreciate that. I appreciate everyone listening. If you guys want to stay on for the extended portion, I'm going to jump back on here with Ian and talk about what we're seeing in an expansion of setups with small caps outperforming. Next week is Thanksgiving. We'll see if we're going to record a podcast. If we do, we'll try to get that out prior to Thanksgiving. Or I'm sorry, we'll record it on a Wednesday and possibly get it to you that weekend. But if not, enjoy the time off from us and enjoy spending time with family on a tremendous holiday that we recognize the blessings in our lives and give thanks for them. So enjoy that and stay on for the extended portion. Otherwise, you guys have a great week ahead.
Have a great weekend, everyone.
All right, Ian, heading into the extended portion of the podcast here, I rudely cut you off in the client segment because I didn't want to get too far in the weeds on what you're seeing from a scanning standpoint. We do use a scanning process as part of the adaptive process, and what you're seeing in an environment where small caps are outperforming large caps. What does that look like?
Yes, so particular scan we're talking about, it's the same scan I've been doing every day for years. So I'm pretty in tune with it and just what it looks like, what comes up during particular market environments when we go from steady climbs and seeing numbers rise on things like new highs and new lows or big thrusts and what those can mean. And, for a while, it has been more large cap names leading small caps, right? And we know there are fewer large cap names just because the law of numbers. And now that small caps and micro caps have, which there are many, many more number of stocks that fit that market cap criteria, now that they're beginning to outperform, you're seeing all of that start to bubble up. So just a lot more setups in general.
Yeah, more to choose from in that. I mean, it's intuitively obvious, right? It makes logical sense that if you have a basket of 2,000 to 3,000 stocks outperforming a basket of 500, you're just going to have more stocks that
the universe has gotten just that much bigger now. So it's a lot to sift through. I mean, even intraday scanning you're looking at a minimum 500 to 700 before we even get to 2:00, which is when we kind of start our decision-making process.
Yep.
Now, granted, we can make lots of decisions, and then in the last 30 minutes, we start to get a bad close and things can change. But we'd say we start our prepping at 2:00 for the most part, obviously communicating throughout the day.
2:00 Eastern.
Yeah, 2:00 Eastern gives us a good 2 hours to get bullets in the chamber, per se, regarding trades we might want to take into the close. But a lot of work, and thankfully we have technology that can whittle it down for us, or gosh, I don't know what we'd be doing.
Right. It makes sense to use those tools for sure. One chart I kind of want to pivot to that our great intern Pratty put out is just the percentage of stocks above their 200-day moving average in the S&P 500.
Mm-hmm.
Where are we at on that?
I believe we are above the. Are we above the January 2018 highs? Well, or are we above the February highs?
Well, right, and it's one of those things where we're seeing, upwards of 90% of stocks in the S&P 500 above their 200-day moving average, and that's not necessarily a bearish characteristic. In fact, Dietrich had some great stats out there on what the S&P 500 does performance-wise after that happens, after we see more than 85% of S&P 5 components above their 200-day moving average.
And what did he say?
Well, and the returns on a 1 month, 3 month, 6 month, and 12-month basis, those periods, those are all have greater performance numbers than the average returns of the index. So as an example, the 12-month return after greater than 85% of components are above their 200-day moving average, the average is 8.8. With that characteristic of greater than 85% is 11.1. That's just an example of that.
And that's over what time frame?
12 months.
Wow.
But it's every single time frame. For example, the 1 month is also higher. The 3 month is also higher. The 6 month is also higher. So in a way, it's a type of breadth thrust. That doesn't mean we can't correct from here. That's not what we're saying. It's just the data supports that type of thrust above a 200-day moving average doesn't have a bearish characteristic about it. And what's interesting too is if technicians were to look at, how is a 200-day moving average constructed? Sometimes we forget that, and we think about the data that's dropping off the backside of a 200-day moving average. So every day, like tomorrow, the last piece of data on that sequence is dropping off. And we're starting to head into a period for both the 200-day and the 50-day where the data that's dropping off the backside pretty soon, within the next few weeks, is going to be data that's pulling the average down. And so when that's dropping off, that's going to cause an acceleration of these moving averages to the upside. So we have this interesting circumstance in our hands where we have this thrust, if you will, above a 200-day moving average. That doesn't mean we can't move sideways or have some type of correction from here, but yet we're likely to see an acceleration of the 200-day and 50-day moving average moving forward 3 to 4 weeks from now. So that's not a bearish thing either.
No, it is certainly not. An upward sloping 200-day moving average.
Much better than a flat one.
Much better than a flat one.
Those are as JC puts it, a hot mess. So last week we talked a little bit about Japan. And breaking out of a 29-year base. And you sent me something today regarding the index, the construction of the Nikkei that blew my mind. I knew it was a price weighted index, but can you elaborate? I just wanted to swing back to it because it's an important development that we're breaking out of a 29-year base on the Nikkei.
Yeah.
But
So
I didn't have a full understanding of what's going on and how they formulaically approach the Nikkei.
It's
And we don't have to go through every single piece of detail, but there's a couple things in there that I think are worth highlighting for our listeners that are.
well.
And this
so some interesting things that stood out to me. So it is a price weighted index. I guess it's, people do refer to it as the Nikkei Dow again because both are price weighted. I think the Dow's kind of a ridiculous index, but the Nikkei 225 might take the cake on that.
And I should give credit here too to Travis Lundy. At Travis Lundy Asia is his Twitter handle. He's the one that put this information out
there. He did.
But feel free to walk through that because it's just
I saw crazy. From a retweet, but it's a pretty fascinating way that they came up with their index, and that all stocks are tied to a par value at IPO.
Yeah,
which I thought was really strange. And then how that it's really about, and I guess this kind of explains why this index has been so wonky for 30 years. And that due to a lot of these rules that the Nikkei and the governing body came up with, this formula, that it really
governing
dissuaded
like
companies. So it dissuaded companies for decades to not really have stock splits.
Yeah, so they were changing the rules of the game that completely negatively impacted the index.
And basically because they didn't want weightings to change. So, for example, we just saw Apple, which is the largest weighting in the Dow, has a stock split. Now it's dropped down to, I don't know where it is now, but the last, I think it's out of the top 10 weightings.
Right.
Because it went from 425 to $100 or 500 to 100, whatever it was.
Right.
Well, they didn't want that to happen. So because of this formula they created, things started to get really wonky. It was basically frowned upon to split your stocks. So you had, at a point in the 90s and the 90s, stocks over there, they had lots of stocks that looked like a Berkshire Hathaway Class A, trading for $200,000-300,000 American dollars a share. And I guess they've kind of fixed it over the last. They've changed the rules again in 2005.
But it's just fascinating to see that a governing body can have that much impact on such an important index like the Nikkei. For example, I just had to look it up because Apple went from number 1 to number 19.
I was going to guess 18. Okay, so 19.
So 19, and it might have been 18 at the time or 17 or whatever. But, in the situation on what the Nikkei was doing or what their regulations were, it would have kept Apple at the same weighting. Mm-hmm. Now, I could see why people would want that. At the same time, if you're using a price weighted index and then you make everybody list at par, and in fact, the weirdness, you got to go check out the string. If you're on Twitter, you have to go read this. Just the things that they were doing even in the year 2000, where there was basically a reset, and they made everybody price at par.
Well, and then they changed the par value for everyone.
Correct.
So everyone goes IPOs. It originally started at 50 yen, I think.
And so
then they changed it to 5,000 yen, and then for a little bit 50,000.
Well, so in April 2000, they change a rule because they want to get rid of some old stocks. So they add 30 new tech stocks that eventually become up 50% of the index. 30 stocks were removed, and then the other 195 stocks in the index had their weightings drop from 90 to 50, so that everybody was on this. It was like a reset of the index. Really interesting that they did that. And really, if you think about it, the index really struggled after that point. So it's fascinating, understanding that the Nikkei is a price weighted, but not understanding some of the outward forces that were forcing, that had knock-on effects for how companies listed, what they thought about splits.
Well, and
fascinating.
And he points out that when they shoved those 30 stocks in, that basically it rallied for 4 days, 50% over 4 days. And then that was the top. The index fell by 50% over the next year.
Yeah. That basically marked the top of the tech bubble too. So really, really interesting information. So check that out. Travis Lundy. It's at Travis Lundy Asia is his Twitter handle. Check it out. Very cool to read through that. So we talked about expansion. We talked about breadth expansion. We talked about scans and setups. One relative chart that I think sticks out to me as having a massive amount of relevance in the current environment is something like Apple versus the S&P 500.
Will it continue? Will it hold its uptrend? That is a big question.
And there's a lot of compression heading into this sequence that's gone back since August. It's fallen off on a relative basis versus S&P 500. From a technical standpoint, perfectly normal to see price compress like this. As technicians, the information is basically binary. If we're breaking upwards out of this compression, it's confirmation of the uptrend continuing. If we're breaking down from that, very hard to see the S&P 500 do well in an environment where Apple is leading to the downside in that relationship. It can happen with rotation. It would have to be a tremendous amount of rotation that would have to continue in these financial energy names. And it is interesting that for the month of November, the two worst major S&P sector performers for the year on a year-to-date basis, energy and financials, are the best performers over the last 1 month period.
Last 1 month period, we had mentioned that that small caps, which, we think about energy and financials when you think about small caps, led last week. They have a pretty hefty lead. I know there's a session and a half until we're done with the week, but a pretty hefty lead, up over 3% this week, with the NASDAQ up 1 and the Dow and the S&P less than 1. So,
and those could be reversion trades. All it is noting that we have one of the all stars, the big cap tech names, on a relative basis versus something that versus the S&P 500 compressing, trying to hold an uptrend or rate of uptrend, and we're looking for that. Upside confirmation would be very healthy for the market overall. If we have that break to the downside, that's also going to be information that other areas of the market are going to have to continue to step up like they have over the last month, or there's going to be a sideways or down market. It's problematic to have your
tech
all-stars.
Negative for the week this week so far, along with healthcare. The healthcare relative chart really looks like it might take another nosedive.
Yeah. And think about that in an environment of, tremendous vaccine news and therapeutics that we're seeing, healthcare get sold off. So it's not, don't base everything, just wrapping everything up, bringing it full circle. Don't base everything off of news because it's not going to give you any type of edge.
Industrials, so energy, industrials, financials, the leaders so far this week. Utilities getting hit. Actually, utilities getting hit with, in fact, I think treasuries are up this week. So interesting that your bond proxy is having an inverse relationship with bonds. I say that facetiously.
Yeah, I know. I completely get it. And we're seeing something like emerging markets setting up on a relative basis.
Emerging markets, lots of strength coming overseas. I would say some of those European countries that we talked about before, like Denmark, are looking like they could take another relative move higher. European small caps look strong. So a lot of interesting.
You're not necessarily hiding out in European small caps if you're afraid of the market correcting.
No, and European financials have seen relative strength lately.
Well, and Deutsche
So,
Bank, a big piece of
mhm.
that, continues to fall through the upside after an island reversal back at the end of September.
And right, I mean, that would make sense. Our last multi-year run that we saw in small caps, in energy, in financials, in banks, in industrials, was also with we saw
International.
international emerging markets, things like that. Now, yes, and that was 03 to 08. We saw that for a little bit in 2016, but never turned into a big macro trend, I would say. So we'll see if this is the beginning. I would say it's the best shot that it's had maybe since 2016 with the new relative highs we're seeing in small caps.
Yep.
Now we saw the same thrust after the election in late 2016.
Could be the same sequence playing out.
And then it was a hard fade after that. But
well, and as long as we're staying above, something like 173 on IWM, or even the 2019 highs near 170 on small caps, perfectly healthy, perfectly normal. S&P 500 would be great if we held above the September highs, but we could fall back down into this range, and really 3200, 3250 is that big line in the sand that if we're breaking below that, we don't really need to be involved with stocks below that level. But that's to be determined. I'm not saying that's going to happen. It's just for us.
And I'd still say that sector, I mean, maybe if we want to take the broad S&P sectors, the only one that has shown, I would say, the beginnings of a new trend. I'd say a lot of these sector relationships are sideways. I mean, communications is sideways, tech is sideways, but industrials is really the one I would say that over the last week has asserted itself. I'm still not quite sure about energy. I don't need to be participating in that yet, but industrials.
Well, in energy, that goes back to, and we've said this before, that if a type of bottom is taking place, this huge weekly RSI divergence and lower price low, this is how a bottoming process would begin. But you're right.
Yeah.
When you're looking at it on a relative basis, it's still upper left to lower right.
I mean, when you look at and when you pull up something like healthcare versus the S&P on a long-term chart, so let's say going back to 2011.
Yeah, it's on a cliff, man.
I mean,
on a verge of a breakdown.
We are looking at a potential multi-year underperformance from healthcare stocks.
Yeah, that could be about to be unfold, meaning that if we're breaking below on a relative basis, something XLV versus S&P.
I'm thinking, I think potentially healthcare stocks, if they were to go back to those 2011 lows, I mean, that's over 20% of underperformance. Correct. That you could see over the next 2 to 3 years. And they've just had a lot of chances to break higher. I mean, I remember getting excited about healthcare back in April because on a relative basis, we were making a pretty big move. And that has done, and so since we've had this news leading up to a vaccine, healthcare underperformed. Then we get vaccine news, and it continues to underperform. Yeah, interesting.
Healthcare is definitely on the brink on a relative basis against a lot of different charts. Whether you're looking versus the S&P, looking against like just comparing it to tech. Definitely on the precipice, one to pay attention to
because it's so much of the pharmaceutical names. I mean, you've still got medical devices, looks great.
Yes, there are. That goes back to there are sub industries within these sectors that are still performing just fine.
I mean, you've got medical equipment is not too far from what could be 2 to 3 year relative highs. But because you've got these pharma stocks that I think are like 40%. I mean, look at pharma versus the S&P. You want to talk about new continuous new relative lows. In fact, they're hitting new relative lows again this week, all-time relative lows in pharmaceutical stocks.
Yep.
So again, if that was, that's a sector that gets a lot of attention from the political junkies in the market about what will healthcare look like under different administrations. Well, it's been in a relative downtrend since 2010. So,
and there's been two
sounds like it doesn't really, it doesn't really sound like
there's
politics
one party
play a role.
Right. And we're watching, the largest player in healthcare, UNH, struggle on a relative basis versus
and the largest player in the Dow.
Yeah. Largest component in Dow, largest component, breaking down.
Now it could be, I think maybe we're building a base here.
Yeah, an accumulation, like an O'Neill accumulation type move versus the S&P 500 could be. But until it's very clear, if you're a technician out there and you pull up UNH versus S&P, it's very clear where it has to get above in order for the relative strength of UNH to continue. And if that's going to be weak, healthcare is going to be weak because that's one of the best players on the team. Some of these others have the same thing, whether we're looking at, Anthem's trying to hold a high that it had, but we'll see over time how that plays out. But to your point,
and you
Ian,
see the exact opposite in industrials.
Correct. Yeah. You're seeing strength there, whether you're looking at something like Caterpillar, Deere changing, turning the corner on a relative basis. Those are positive characteristics.
Transports in general starting to turn up again on a relative basis. Still kind of been consolidating since September, but would be a huge, I'd say, one of my favorite transport stocks.
Tell me.
Old Dominion, continues to hold up very well and has been consolidating.
Is that like a wink from the Matrix? Old Dominion? Like, interesting.
It could be.
So ODFL is the ticker you're talking about.
ODFL.
Definitely one of the great trenders if you look at it over time, especially both absolute on a relative basis.
XPO Logistics continues to look so a lot. Transports, industrials, seeing some really good stuff out there. I think that kind of goes when you see a Deere, Caterpillar. I think Cummins has been pretty well. Those are kind of international themes as too. So,
well, and kind of swinging to industrials, materials, those types of things. One of the bigger leaders in that area too is AMAT, Applied Materials.
Yeah,
good on an absolute basis, holding up really well or doing really well, confirming the trend. So these are quality, and in fact, reaching towards the relative highs that we haven't seen since 2018, and tends to be a bellwether. So we'll see. I mean, we're starting to see the characteristics show up of if we are seeing a shift to value, this is what it would look like. We'll see if it holds, because some of these compressions in Apple and Microsoft and Amazon could resolve to the upside. And 2 to 3 weeks from now, we could talking about the reestablishment of the tech uptrend. We'll see.
We very well could be. Lucia's pulled that ball many times this year on investors and traders. But again, and a lot of these names, Pratty mentioned this yesterday, we're finally seeing these small caps, both on an absolute and relative basis. A lot of these names get above those June highs. So I think that there is more working in favor of a flip to value than we've seen in the last few months. There's evidence there. Yep.
Price is the evidence that matters most. So we'll continue to use that. We're bumping up towards the end of our podcast. We've got to jump off and do another prospect call here, Ian. So we'll close this down. As always, I appreciate you and the entire Adaptive team. Great to have Kevin back this week after hiatus. Pratty continues to do great work. So do you. So thank you to you guys. Thank you for everyone for listening. Enjoy your Thanksgiving. If we don't get a podcast out for that, just enjoy that silence then. Reserve that silence for the weekly trend and just sit there and enjoy the quiet. Or we'll have something for you and you can listen to it. It'll be the greatest thing ever. So other than that, thanks, Ian. And thanks everybody for listening. Have a great week ahead.
Have a great weekend, everyone.